Tech Canada webinar series. This is our first move to Zoom. We've been using a previous platform, so I apologize and I appreciate everyone's patience as we kind of work through a few of the kinks here. You may notice that we are also going to be launching into a financial theme. So all of our webinars from today on to the end of June will be focused on financials on one aspect or another. So it is my pleasure today to welcome Adrian Cronje from Ballantine. Adrian is the CEO and founding partner there in Atlanta, a very large investment firm. But one of the special things that I wanted to say about Adrian and why I've invited him back again is that he is a key consult for Vistage, which is our sister organization in the United States. And he has also been a longtime member with Vistage. So his understanding about our members' needs and about what we are looking for is unparalleled. So at this point, Adrian, I'm going to turn it over to you to take us through this walk. Welcome.
Thank you very much for that kind introduction. I hope you can hear me clearly.
We sure can. Sound fabulous.
So much. Thank you so much. And it's a pleasure to be back with you all again. Boy, does it feel different to a year ago, I think, or actually about 9 months ago when I last spoke to this audience. So I look forward to updating you on the outlook. Remember, a central message that I like to leave with Vistage members and with tech members is how important it is to understand the messages that capital markets send us each and every day about the future economic environment 12 to 18 months out. And I'm going to walk you through an update on those messages today because obviously they are quite different to the messages they sent to us back in the dark days of March and April last year. And then what I'd like to do is to tease out some implications for your business. You know, as many people have written, the COVID-19 pandemic has really accelerated several trends that were already in place prior to 2020 that have a long-lasting impact in the way in which we go about our business. And then I look forward to answering any questions that you might have. I understand that you have the ability to stop and interrupt me at any point. I'll try to keep an eye on the chat room, but please don't hesitate to unmute yourself and ask me any questions as we go along the way. We've got about 45 minutes, I think, for me to get through my main points and leaving about 15 minutes for Q&A. So this is really the edited highlights of my session. I'll say at the outset that we won't have enough time to cover everything. You know, I'm often asked during these updates about how one should go about investing portfolios as a result of our outlook. And, you know, my answer to that is always the same. I can't give you very specific investment advice without understanding your context. You know, investments made without context are accidents waiting to happen. And although we won't have time explicitly to cover it today, one of my projects during COVID-19 was actually to take it one step back and to think strategically about investment philosophy, about investment implementation, which we now call our Ballantine Investing Cardinals. And that's partly in homage to a Vistage legend, former CEO Red Scott. Maybe some of you have come across his pithy 30 or 35 business cardinals, which stand the test of time. And so partly in homage to Red, I wrote some investing cardinals, which hopefully are some long shelf life pieces of advice for you to think about how to go about investing your portfolios outside of managing your business, given the outlook that we have. And I will be sure at the end to make sure that I refer you to some resources that are available to you on our website. We have created a specially dedicated page to Vistage members. So if you go to Ballantine/Vistage, you will be able to download some of the resources and references I'll be making along the way, as well as a request to receive these Ballantine Investing Cardinals so that you can track along some of my comments in your own time in depth. And I will remind you all that I am always available as a follow-up to discuss any of the things that we talk about today. So let's start by at least acknowledging that that horror story of 2020 is at least over. 2020, if it was a movie, in my view, would have received a single star with the comment, "It was very bad, would not recommend." We had a global health pandemic We had unemployment figures in the United States and elsewhere that approached almost mini depression levels. We in the United States experienced social unrest. We then followed that up with a particularly poisonous and bitter presidential cycle. All that, thankfully, is in the rearview mirror. And capital markets today, in a nutshell, are signaling a much more optimistic outlook 12 to 18 months out than they were a year ago. As a quick reminder, the methodology that I encourage you all to be familiar with is capital markets. And what I mean by capital markets are the conjunction of the stock market, the bond market, the credit market, and the commodity market, which I think you Canadians are especially aware of, how important commodity markets are a signal to the future of the Canadian economy and the global economy. Perhaps those of us in the United States who are more inwardly focused are less attuned to that important signal, but I would argue that's the fourth and most important signal to keep an eye on. And the reason why capital markets are so powerful in helping us think about the future is that they harness the educated, forward-looking expectations that investors in each of these markets have about the future economic environment. And as the slide highlights, ultimately greed and fear, or euphoria and despondency, are always at play as investors think about the future. And these investor emotions cycle gradually and repeatedly through time to send us forward-looking signals about the environment 12 to 18 months out, which I would argue is a minimum time horizon that is useful for us as business owners to course correct our business strategy. It is no good knowing that there may be a downturn on the horizon 2 to 3 months out, because it's very difficult to make course corrections. And as a reminder, I often remind audiences that listening to traditional or to listening to economists and strategists that use traditional economic forecasts about the future is a little bit like driving the car down the road by looking in the rearview mirror. That is not to say that economists, indeed, I am one of those, so I think I can speak credibly on this issue. Economists and strategists don't understand the future economic environment simply because they have theories that understand the way in which the world works. It's just that they're typically putting inputs into those theories that are backward-looking and often subject to revision, which makes their forecasting prowess over a useful horizon, like 12 to 18 months, not quite the same as what capital markets would send. As I think I said to you a year ago, think about economists and strategists a little bit like your cardiologist. Just like a cardiologist, they are able to describe the set of circumstances that are likely to lead to a healthy lifestyle or to eventual cardiac arrest. They are not able to pinpoint exactly when that occurs, but when it does, they have the playbook to resuscitate the patient, just like an economist has the playbook to resuscitate an economy from a recession. So over a shorter term time frame, certainly the momentum and underlying economic data can certainly tell you what's likely to happen. The point I'm trying to make that over a useful time horizon, like 12 to 18 months, it is somewhat limited. And here the resource that I would refer to you to are, it's called the Are Recession Red Lights Flashing? You can get that at ballantine.com on our Insights page, but also on our Vistage page, free for those of you in Vistage and in Tech Canada. So for greater detail, as I try to summarize this, you can track along with that particular resource. So let's get to it. What I've traced here are the 4 capital markets I urge everybody to become familiar with: the stock market, the bond market, the credit market, and the commodity market. And I trace on this particular table what those signals were back in the first quarter of 2019, the first quarter of 2020, around about this time. And I'll walk you through what those signals are telling us in the first quarter of 2021. And obviously, if you can think as far back as 2 years ago to the beginning of 2019, those signals were fair to strong. That put my methodology and my message at loggerheads to many economists and strategists at the time, who were very quick to be calling a recession to occur in 2019 in the United States and perhaps globally, because we were in the 10th year of an economic expansion. And to many economists at the time, it looked like that we had run out the clock on the expansion continuing. By the first quarter of 2020, and indeed during the last 3 weeks of March, obviously those fair to strong indicators turned red overnight as the policy response to the global pandemic was to put the economy into lockdown, something that really started to accelerate trends that were already into place. But I want to tell you a story about how pretty quickly these capital market indicators went from red lights flashing across the board to yellow and ultimately to dark green today across the board as the recovery unfolded. But before I do that, I just wanted to remind you all of what the key link is and what the key insight each one of these markets are telling us about the future. So let's start with the stock market. The reason the stock market is so powerful in telling us what's likely to occur there over the next year to 18 months is it's really giving us a glimpse on corporate profitability. This is a key variable because we have never had a recession in our economy without a corporate profits recession. That speaks to how important business is to the United States economy. And that's not just germane to the United States. That is true elsewhere as well as in Canada specifically. It is not a fail-safe indicator, as Nobel Prize-winning economist Paul Samuelson likes to quip. Be careful of the stock market because it has actually forecast 9 of the last 7 recessions. And what he means by that is there have been instances of corporate profits recession occurring without the economy going into a downturn. But nevertheless, it is a hugely important variable to think about the economic environment 12 to 18 months out. If you think about the stock market, essentially the price of any index measuring stocks is essentially underlying corporate profitability today and in the future discounted to the present using interest rates. And so it's a hugely important variable to think about. If the stock market is continuing to climb, that is a signal of a healthy economic environment 12 to 18 months out. If the stock market were to decline and fall into a bear market, and most people in my profession would describe a bear market as a peak to trough price decrease of 20% or more over a sustained period like a quarter or more, as being a good indicator that corporate profits were going to experience a downturn and the economy was going to follow suit. So the stock market is an incredibly important signal to take into account. The second indicator to keep an eye on is the slope of the yield curve. And that message is sent to us by the bond market every day. And the slope of the yield curve in plain English is essentially the difference between short-term interest rates and long-term interest rates. Remember, for bonds of the same credit quality. Remember, for bonds of the same credit quality, long-term interest rates, let's say a 10-year treasury bond, for example, is just the mathematical sum of short-term interest rates up to that point. And so the slope of the yield curve gives us a very good steer on where interest rates are likely to be in the future. You'll see in a moment or two that the yield curve, when it is positively sloped, is a bullish signal about the economic environment, in that the bond market is telling us that they expect interest rates on the short end of the curve to rise because economic growth is likely to be ebullient and inflation is likely to percolate. When, on the other hand, the yield curve loses its slope and inverts, such that short-term interest rates are higher than long-term interest rates, that has been a fail-safe indicator that 12 to 18 months out, a downturn is likely to occur because the bond market is expecting the Federal Reserve or central banks across the world to have to lower short-term interest rates in order to stimulate the economy. So a stock market, bear market in conjunction with an inverted yield curve are two of the first shoes to drop when thinking about whether there's likely to be a downturn. The third most important capital market indicator comes from the credit market, and that's really the corporate bond markets. So this is the ability of corporate America or corporations in Canada to float themselves on corporate their activities, whether that be to hire people, whether that be to make investments into the future from the non-bank lending channel, so essentially floating bonds. And what you'll see in a moment or two is that, at least in the United States, but it's typically true elsewhere in the world, that corporations have to charge a premium of around 500 basis points over safe treasury bonds in order to finance their activities during normal times. When spreads are narrower than 500 basis points, that is corporate bond investors sending a bullish signal about the future, because they expect defaults to be low and corporate America to be doing pretty well. When it exceeds 500 basis points, that is a signal that corporate bond investors are thinking that defaults might be rising because an economy might be going into downturn. And so, in a nutshell, it acts as a pretty good coincident indicator of optimism at the CEO and CFO level in corporate America. So credit spreads that are above 500 basis points, in addition to an inverted yield curve and a stock market bear market, is the third shoe to drop when markets are signaling that a downturn might occur. The last market is commodity markets. And this is especially important to audiences that I speak to in the United States, because we in the United States have become used to the idea that the United States is by far the largest, most robust, most diverse economy in the world. Little known fact, we no longer produce the majority of global GDP. That was the case as we entered the great financial crisis of 2008 and 2009, but that is no longer the case. And that is a reflection of the fact that several countries, especially in the emerging world, but also in the developed world, such as Canada and Australia, but countries like China, Russia, India, and Brazil are the largest consumers and producers of commodity markets. And so a robust commodity market is a signal of a strong global economy and vice versa. And so if commodities, and by commodities, I mean commodities used in the production of things as opposed to precious metals like gold and silver, which act more as a currency, if those prices are robust, that is a signal of a pretty healthy global economy. As I like to remind Vistage audiences in the United States, let's not take home to the bank that we can no longer import a recession from abroad. And I think this is an especially important market to educate yourself, and I know that you Canadians are already familiar with its power, but one of the key themes that's likely to intensify in the coming years is the great reset of the strategic relationship between China and the United States. Obviously, President Trump put this to the forefront when he used a tariff war in order to try to get China to play by World Trade Organization rules and also no longer to steal intellectual property. That has become a bipartisan issue here in the United States, and we expect that great reset of our strategic relationship with China to cast a long shadow over the global economy. And so how China reacts to that, how China is able to negotiate from a position of strength will be signaled to us by commodity markets each and every day. So those are the four indicators that I encourage everybody to keep an eye on. I will remind everybody that no one of these indicators are fail-safe, but used in conjunction with each other really can be a powerful indicator 12 to 18 months out about the future economic environment. I'm going to pause and see if there are any questions at this stage. But before I do so, I'll get to the bottom line. The first quarter of 2021 shows dark green across the board. And the reason for that, in a nutshell, is capital markets are expecting a particularly robust period of economic growth over the next year to 18 months, both here in the United States, but also globally. And that comes from the enormous amount of fiscal and monetary stimulus that has been brought to bear by the United States authorities, but also elsewhere in order to provide relief to an economy in lockdown, which is coinciding with real progress in the adoption and distribution of an effective vaccine, which is allowing the economy to open up and for a huge pent-up demand in services to be unleashed 12 to 18 months hence. And that's a really, really powerful environment for us all as we think about managing our businesses. Perhaps the biggest risk is to be too negative about the outlook 12 to 18 months out. But I wanted to walk you through this methodology because you can use it each and every day to monitor progress, because obviously the outlook is subject to change. And beyond 18 months or in the coming months, you can begin to get a good sign of when these signals might suggest that robust times are no longer here. So let me pause there and see if there are any questions before I walk through each of these indicators in a little bit of detail.
For sure. Thank you, Adrian. Arthur, I have allowed you to speak. So if Arthur, if you want to ask your question directly, go unmute yourself and go ahead. Give him a second. And if he is not listening, and then I can read the question.
Go ahead, Ruth Ann, I'm listening.
All right. So Arthur's question was, he wanted you to address sustainability, its importance relative to business, and how quantitatively you evaluate sustainability.
So sustainability is a huge issue. There are actually two issues that I expect businesses such as mine and Ballantyne and yours, Arthur, and businesses across the world to really have a good answer for. One is diversity and inclusion. The other is sustainability. And so the issue of sustainably managing a company is at the forefront of our mind. But when it comes to investments, you know, I see the debate having moved way further from, you know, just socially responsible investing to environment and social and governance issues. Those are more a restrictive way to think about reducing the opportunity set in order to index on some criteria, which, by the way, is different for everybody. And I've seen the conversation move so much more towards impact investing, where the trade-off between returns from a pure investment point of view is not as steep as from an ESG mindful point of view. And those tend to occur in the private market area. And so I am seeing a lot of efforts amongst my client base in my industry to address sustainability through impact investing, where companies are started, you know, to address these particular issues. So I hope that answers your question, and I'd be happy to talk a little bit further about that offline after today.
Excellent. And I'll ask anyone, if you want to raise your hand, I will give you the ability to unmute yourself. So I know this might be a bit of a red herring in there, but talk to us about the disruption in the stock market most recently with Reddit. Does that, where are we at with that? Or is that just something off to the side?
So, you know, I think it's important for us to stay grounded in what occurred and not to get too carried away about the shock and awe volatility that has occurred. You know, I see the Reddit issue really being an outcome of the great democratization of people's access to be able to trade, coupled with the fact that trading today is a lot easier to do and is more inexpensive than it used to be. And really what happened with Reddit was, you know, retail investors seeing that an institutional investor had become way too much of the short interest of a particular stock, and in a sort of a populist way went after that. And so in some ways, I do see it as a sort of a healthy way in which retail investors are participating in markets in order to aid the price discovery process. And so, of course, it looked sensationalistic given the amount of volatility that occurred, but essentially, an institutional investor was not paying enough attention to risk management, where they became too much of the short interest of a particular stock, and retail investors were able to act as a group to enforce a short squeeze. And so that's the context with which I would see that. Perfect.
All right, I'm going to mute myself, turn my video off, and let you carry on, Adrian.
So I'll be delighted to. So in the interest of time, I'm actually not going to walk through each of the slides on these indicators, but you know what I will point out with the stock market is, you know, it was tempting to think about what happened in March and April last year as a sign that the economy was going to go into an extended recession. And actually, that was not the case, albeit the fact that the stock markets tended to drop by a third in a matter of weeks. What has been underreported is just how quickly they've recovered since then. And that has a lot to do with the fiscal and monetary stimulus that was brought to bear in order to bring relief to the economy. But also, it really speaks to just how profitable corporations have remained during this episode. That is not to say that there are certain industries that have clearly suffered distress, where assets have been stranded during lockdown. Obviously, those tend to be in the services sector that are dependent on people gathering to do business. So travel, leisure, hospitality are good examples of that. But really, underlying profitability has remained very, very resilient throughout the pandemic and is expected to grow pretty robustly over the next 12 to 18 months. And so the price action in March and April last year actually did not constitute a bear market of a 20% drawdown that lasted 3 months or more. The stock market recovered pretty quickly. What you find is when stock markets crash over a short period of time, that typically resolves itself quite quickly. It's really that extended bear market that should be an indicator of economic duress 12 to 18 months out. Here is the slope of the yield curve from the bond market. I make the point here that that yield curve tends to invert. In other words, short-term interest rates are higher than long-term interest rates, and that yield curve tends to go negative 12 to 18 months out prior to a recession. Indeed, over the last 50 years, there has been no instance of a recession in the United States without the yield curve inverting first. I did highlight the small yield curve inversion in 2019, just to make the point that actually it did not invert in a sustained way. For a couple of days on an intraday basis, the yield curve technically was negative way back in 2019. But that was not because the bond market was smart enough to figure out that an unforeseen shock like a coronavirus pandemic was about to hit 12 to 18 months out. That was really to do with the issue of the time where President Trump had escalated the trade war with China, and the market was concerned that given that context, Chairman Jay Powell, our Federal Reserve Chairman, was actually being too aggressive in raising short-term interest rates, removing the punch bowl away from the stimulus that they had provided the economy in the aftermath of the 2008 and 2009 crisis. So it actually flirted with inversion, but quickly recovered its positive slope. And, I really dial in here at just how steep the yield curve has become during the COVID-19 recession. You'll see there in March last year how it was on its way to inversion. But one very, very significant event occurred that Sunday afternoon, 2 days after President Trump announced to the United States that we were going to go into lockdown as a way to try to slow the spread of the virus so that our healthcare system did not get overwhelmed. And that Sunday afternoon, Jay Powell said something very, very significant that I'd encourage you all to think about, because it really sets the stage for some trends that are likely to cast a long shadow over the next few years. He got up that afternoon before markets opened on Monday and said this: we learned our mistakes from dealing with the 2008-2009 crisis, and we're going to do everything in our power to make sure that the recession that's inevitable from a lockdown does not become a solvency or liquidity crisis like it did in 2008-2009, when we really didn't know how to deal with it, and we dealt with it in a very halting and incoherent way. So we are going to drop interest rates all the way to 0% tomorrow morning. We're going to promise not to raise interest rates for a long period of time. And very critically, and you'll see how important this is for credit spreads, we are going to buy assets in unlimited quality, in unlimited quantity, using our balance sheet in order to make sure that spreads did not blow out, so that distress did not become incipient in the economy as a result of the lockdown. That's a pretty dramatic change in the way in which the Federal Reserve thinks about monetary policy. They were very attuned to the fact that they wanted to make sure that capital markets would continue to function and continue to digest the dramatic bump of a decline in economic activity during the second quarter of last year that resembled depression-like qualities. And what you've seen is since then, how the bond market has realized that the Federal Reserve is being serious about this, and how steep the yield curve has become, and has become quite a bullish indicator that, with low interest rates for the foreseeable future, with the Federal Reserve continuing to use its balance sheet in order to make sure that markets function, coupled with what they did in August last year, doubling down on this approach by saying, we are not going to stop until we see inflation actually start to rise. Because you know what, for the last 10 years, everybody's criticized us for the manner in which we've been allegedly printing money, but yet we have persistently fallen short of our inflation target. And so we are going to let the economy run a little bit hot as it recovers from the COVID-19 pandemic, and allow inflation to run at a little higher than our 2% target, so that on average, we can hit the 2% target over time. And so that's a pretty significant signal to us all to be ready for above average levels of inflation in the next few years, which as a business owner has all sorts of implication that I'll get to in a minute or two about your pricing strategy and your ability to raise prices in order to get ahead of rising costs of input so that you can protect your margins. That Federal Reserve promise to buy assets in unlimited quantity was really seen in how credit spreads on this particular chart, this is the third indicator to indicate, quickly collapsed after blowing out when they became concerned about the number of defaults that were likely to occur as a result of lockdown. The Federal Reserve that Sunday afternoon said they were not only going to use their balance sheet to buy treasury bonds, but they were going to explicitly buy both corporate bonds and municipal bonds here in the United States, where they saw the potential for distress. I'll show you a chart in a minute or two, how their balance sheet really reflects assets in corporate bond markets and municipal bond markets. And you can see how the Federal Reserve's monetary policy response has been pretty dramatic in lowering corporate spreads, so that in aggregate, in light blue, they are below that 500 basis point line today. Pretty dramatic collapse in credit spreads. And then finally, in commodity markets, I've highlighted here the Bloomberg Industrial Metals Index in light blue, and drawn a distinction against the Precious Metals Index, just to make the point that the commodity complex that I think is relevant for economic growth is commodities that are used in the production of things. So the price of copper has become known as Dr. Copper because of its forecasting prowess on the health of the global economy. And you can see how quickly the industrial commodity index has recovered during this recession as a result of the view that, in the emerging world, especially where economies are more manufacturing than services based, they led us into the pandemic, they have led us out. And you'll see in a moment or two that commodity market price inflation is a key theme going forward, signaling to us that the global economy is likely to remain robust. And so in a nutshell, the happy news is, at least from a US perspective, but I think this is generally true abroad as well, is that the capital market indicators are signaling deep dark green across the board today. That is subject to change, but hopefully I've reminded you of the dynamic by which you can understand how they change each and every day so that you can monitor them in real time. Again, the resource I would call out here are recessions, red lights flashing, which you can pull off of our Vistage website at ballantine.com. So I hope that all makes sense. I thought it might be helpful to just talk about a few key themes along with some charts before we pivot to implications for businesses. But again, Ruthann, let me pause and see if there are any questions that have appeared in the chat box.
We don't have any questions that have come up just yet, and no hands have been raised. So I think everyone's eagerly waiting for you to go into some of the themes and indicators. So we'll let you carry on.
Thank you. So let's start with the first and most important theme, and that is the course of the virus. Ultimately, the sharp and severe recession that we experienced and the sharp recovery since then, which has been uneven, but sharp nevertheless, has a lot to do with finding a scientific solution to a scientific problem. And so what scientists and epidemiologists were able to accomplish last year in bringing to bear several vaccinations with such high rates of effectiveness in such a short period of time is certainly been revolutionary and is the stuff of Hollywood movies. Of course, in the United States, the issue we've had to deal with in recent weeks is making sure that these vaccinations are quickly and efficiently distributed and adopted. And so we have been moving at warp speed until now. There have been some very encouraging signs that over the last few weeks, especially, the rate of distribution and adoption has really accelerated. And I'm going to show you a slide or two that will show you that with some key assumptions that can be made, that herd immunity here in the United States might be achieved as soon as the end of May, which is not often what you read about in the newspapers, but that will really allow the economy to open back up more quickly than people have anticipated until now, which is a key reason why there may be such a recovery in some of the sectors that have been left behind in the recovery until now. An additional tailwind and a key theme this year is the additional fiscal stimulus that our Treasury is bringing to bear in order to bridge, today's 7% of unemployment to full employment through time. And so the House passed the $1.9 trillion of fiscal stimulus, which is currently debated by the Senate in its reconciliation process. But the odds are that that $1.9 trillion of fiscal stimulus is likely to pass by the end of this month, bringing to bear additional fiscal stimulus in support of the economy. I'll show you in a slide or two just how much fiscal stimulus has been brought to bear, but that certainly is going to help those that are unemployed become employed again as the economy opens up again. That will allow a huge pent-up demand for services that has occurred from spring 2021 to unfold. And so the services sector, especially those areas that have been stranded because they've depended on people gathering in order to conduct activity, will really, really power economic growth. And you can see that in the stock market, by the way. The stock market's gains, recall that slide I showed you, which had really been powered by profitability until recently, have really been driven by large cap growth stocks. What we're starting to see in the stock market now, as it anticipates a reopening of the economy, is a real rotation towards more of the cheaper areas of the markets that have been more distressed during lockdown, and value starting to make a comeback. And so areas such as financials, areas such as consumer discretionary, even areas in the energy sector, which I know will warm Canadian hearts, are starting to outperform in a pretty dramatic way. I think a key theme that we all need to get used to is rising inflation expectations, rising long-term interest rates, and a declining US dollar. And this all goes back to what the Federal Reserve has committed to doing, essentially financing all of the very large amount of fiscal stimulus that has been brought to bear by promising not to raise interest rates at least until 2023. So at the short end of the curve, interest rates are likely to remain anchored as inflation expectations pick up. Of course, long-term interest rates have already started to rise. For those of you that follow the bond market closely, you will know that the last couple of weeks have been full of stories with the long-term Treasury bond starting to rise to around 1.5%, full percentage point of where it was in March last year. And that really speaks to rising inflation expectations in the coming months. Another key theme that I think is not yet well understood or well reported on, but something I know my Vistage group is really focused in on, and I encourage you all as business owners in Tech Canada to think about, is some of the productivity growth that you are able to unleash in your business. Going into lockdown so quickly forced us all to adapt and to innovate and to bring forward investments in technology so that we could continue to do business in lockdown. And here I'm not just talking about virtual communication, such as me being able to give a talk today via webinar across Canada, I'm talking about advances in automation, in robotics, in artificial intelligence, in the blockchain protocol underlying cryptocurrency, the digitization of the payment system. All of these technological enhancements were already in place prior to COVID, but have really been accelerated during the lockdown. And it's allowed us all to do more with less, which will allow corporate profits, to continue to recover perhaps more quickly than people anticipate. And perhaps the very thin silver lining of this human tragedy of the COVID-19 pandemic is massive amounts of productivity gains that we might be able to reap from bringing forward all of these technological enhancements. And then ultimately, the markets and the capital markets signals 12 to 18 months out are not yet thinking about the medium to longer term consequences of the policy response that has been implemented to bring relief to the economy. But I would argue that as 2021 runs its course and as we begin 2022, especially as the current administration faces its first midterm elections, around the corner is how do we all pay for this all? And how do rising interest rates, rising inflation, how does a lower dollar help to put the debt that we have built up on a more sustainable trajectory, particularly in the light of the fact that in coming years, there are increasing rates of baby boomers starting to retire and that demographic tide turning against us. And so at least here in the United States, the sustainability of some of the entitlement programs, the grand bargain that we made in the 60s as it relates to Social Security, Medicare, and Medicaid will have to be addressed in order to ensure that markets feel comfortable that the debt that we built up that really was accelerated during COVID-19 has a pathway to being sustainable over time. And as I mentioned before, the last key theme is I expect the US-China strategic relationship and global trade to intensify in the coming years. This has become an issue of bipartisan importance. It's no longer just an issue that the Trump administration raised, but that is an especially important part of a key theme in the unfolding years. Several of these key themes we discussed in what I call our Road to Recovery series down at the bottom of this slide. Again, at the Vistage website at ballantine.com, you can download some of those podcasts. You can listen to those at your own time. But over the last year or so, we assembled panels of experts to talk about some of these key themes and how it relates to businesses. We did one on supply chain innovation. We did one on the private capital markets. You might find those podcasts to be helpful as you think through how these key themes not just affect the future economic environment, but also about your business. So let me pause there, Ruth Ann, again, and ask if there are any questions before I just illustrate some of these key themes with some charts and then pivot to implications for our business.
Great. I am so glad that you brought up the idea about the increased productivity that's come through what you call tech acceleration.
Yes.
Because, that really has been a theme amongst a lot of our tech groups.
Yes.
And tech with the small c and not the H, is that there has been so much innovation, so much development of new product lines and also delivery models that across the board. And so we will really see a lot of this pop in the next little while as people really start to leverage on it, I think.
There's no doubt about that. And, maybe a resource for you here is to mention a Vistage speaker, David Hooley, Houle, that has come to my group a couple of times. He's been talking about the 20s being the most disruptive decade in a generation. Yeah. And he talks at length about these tech acceleration themes and how it's going to force us to do business in a different way. And so, I can see it in my own business. We've been able to operate seamlessly, implementing our disaster recovery plan. And I've really reflected on seeing some people in my business actually being more productive working from home, for example. And so it has all sorts of attendant implications, but no doubt that is what the stock market has picked up on. In addition to the fiscal and monetary stimulus, this tech acceleration has really been a real tailwind to corporate profitability, which is why it's signaling to us that good economic times are likely to unfold. And it's always helpful, and it didn't seem that way a year ago. But in every crisis, there lies an opportunity, and that opportunity comes from innovation and adaptation. And so the post-pandemic economy is likely to look enduringly different than a pre-pandemic economy. And I think a lot of that will be some of these technological enhancements through time.
Excellent. And you're absolutely right. Innovation has been sort of a driver. And what we're going to see is that those companies that have been able to innovate and meet those challenges are the ones that are going to move forward. Those companies that have said, okay, I'm just waiting for everything to go back to normal, are going to drop off very, very quickly. And so that is the challenge for business owners right now, is to look at what have you changed, what is sustainable, what has collapsed, what is moving forward in your company, and really look at that.
Yeah, I'm going to pick up on that when we finish my talk on some business themes. If you don't mind, let me show you a few slides with some resources that I think are helpful for you all to track through time. I think the first one is this particular slide on vaccination distribution and adoption and the path to immunity. That's something I've been keeping a close eye on. You can find this at cdc.gov and the National Center for Health Statistics. This obviously only relates to the United States, but the sum total of our population that have had positive COVID tests, and so therefore, already have antibodies. The CDC's estimated additional US infections. Then the vaccinations that have successfully been administered is really starting to steepen that curve of the estimated share of US population with COVID-19 antibodies. And I've seen an analyst at MIT who I have followed, and I'd be glad to follow this up afterwards with a reference to it. But this analyst has been particularly prescient in how the course of the virus unfolded last year, but with some reasonable assumptions that are credible, makes the case that by May, 90% of US citizens may have achieved herd immunity. Let's hope so. It's worth keeping an eye on. Fiscal stimulus. Here I trace back all the way to March the 6th, the enormous amount of relief that the US Treasury has brought to the economy, starting with the coronavirus and vaccine R&D bill, which amounted to $8 billion, all the way through the CARES Act and the payroll protection plan that was designed to help you and I as small business owners make sure that we retained our employees and staff, all the way through to the phase 4 stimulus that was announced late last year, to the Biden phase that's currently being reconciled in Congress. We've spent nearly 18% of GDP on fiscal stimulus. And note that we've done that on a bipartisan way. So that is a very, very different approach to the approach that was taken to the 08-09 crisis, where there was much debate about concern for the need for fiscal austerity because debt may run up and, all the chickens would come home to roost. The very big bet that policymakers are making this time around is by bringing shock and awe relief to small businesses and to the economy, especially when that is financed by the Federal Reserve. And here is a picture of the Federal Reserve's balance sheet. Note that that vertical axis denotes trillions of dollars, right? And notice the complexion of the balance sheet is no longer just in treasury securities, but also mortgage-backed securities and corporate bonds, that deficit financing is going to allow the economy to recover quickly out of the gate, which is so important for us in order to make sure that the debt that we've already built up is on a sustainable course. Another helpful resource for you, and I've traced this in the top right, is called tracktherecovery.com. And that is a collaboration between the Gates Foundation, Harvard University, and Brown University to track real-time economic data, private sector data, on what's happening on the ground. And you can use that website to look at it regionally as well. But I pulled off a very interesting chart here on consumer spending. Obviously, our services sector have taken it on the chin as economies have been put into lockdown. But this data goes through to the end of January, so I have not updated it through February, but if you go onto the resource, you'll find it. And it draws the distinction between aggregate total consumer spending, that middle line in dark blue, which really point to point has recovered, was basically not grown at all at 0%. But take a look at the difference in consumer spending between low-income consumers, 8.1%, and high-income consumers, minus 6.4%. And the conclusion I take away from that chart is that there's an enormous pent-up demand from high-income consumers when the economy reopens to spend on things that they've not been able to do during lockdown. So tracktherecovery.org is a fascinating collaboration, another example of innovation. Perhaps in the coming years, we'll be using this type of data rather than government-generated data in order to take a look at the economy in real time. I've traced in this chart in dotted red lines what the value of the dollar has been, as well as, more importantly, in dark blue, inflation expectations, the left-hand axis. And you'll see as a result of the fiscal and monetary stimulus how inflation expectations over the next 10 years have gone up from 60 basis points per annum all the way north of 2%. And so inflation expectations are already picking up and are likely to continue to increase because, as I said, the Federal Reserve is committed to letting the economy run a little bit hot before they take the punch bowl away. And then lastly, I wanted to draw your attention to a slide that I saw, and the source is Strategas, which is an independent firm up on Wall Street. And this is a theme that I think is particularly germane to those of you in Canada, and that's commodity inflation. Remember, the commodity markets in my chart were already signaling a pretty robust recovery, at least as it relates to commodities and so forth. But this particular chart asks the question, if Tesla, for example, needed to build $20 million a car a year, what sort of demand on certain commodities would that place? So Tesla production of 20 million